Hey everyone, after a sharp rally from March lows, many sectors are now again trading in expensive valuation zone. But interestingly, India's top private banks, barring ICICI, like your HDFC, Kotak and Axis, have not participated in stock market rally in the last few years. And they are trading below their historical median valuation. The good part is, their performance has been quite robust, with stable ROEs, decent earning visibility and excellent asset quality. That gives a scope for valuation re-rating. Now that the Q4 results are declared, I believe this is the right time to take a serious look at private banks' FY25 performance. Not as trading bets, but as long-term compounders. That's where in today's video, I've identified the key growth drivers for banking sector along with key risks to keep in mind before investing your money. And then I've done a comparative analysis of ICICI, HDFC, Kotak and Axis Bank across various important KPIs. This comparison will help in getting a good idea and identifying the right investment opportunity. Alright, let's get started. Okay, before we dig into the individual stocks, it's important to understand the current landscape of Indian private banking sector in terms of opportunities and challenges. So first big opportunity for private banks in FY26 is potential revival of consumption demand. With government zero tax rule up to 12 lakh of income starting FY26, it should boost consumer demand, directly driving growth in home loan, auto loan, consumer durable loan and more retail spend via credit card. Then RBI monetary policy is also pushing for consumption demand via injecting liquidity in the banking sector with purchase of thousands of crores of bonds along with interest rate cuts. RBI has already done 2 rate cuts and now that the inflation rate in India is under control with expectation of good monsoon in FY26, there is further possibility of rate cuts. This would reduce the interest rates on home loan, vehicle loan, etc. and would directly push the demand for credit. Although there is one key challenge here, the interest rate cut by RBI is going to put temporary pressure on the bank's NIM, that is net interest margin. It is because banks have to immediately cut down the interest rate on loans when RBI cut the repo rate due to RBI rule of having floating interest rate. But the challenge is banks often don't reduce this deposit rates immediately, especially in the current environment with rising competition and lack of deposit growth, and hence they may face some margin pressure in the near term. Having said this, in the medium to long term, this rate cut is beneficial for private banks as it would boost the demand for credit growth. So if loan volume grows fast enough, total net interest income may still rise even with slightly lower margins. Apart from this, one of the most important factors is that today the private banks have excellent asset quality with very low NPA. So banks have more freedom to grow their books aggressively and capitalize on rising credit demand without worrying about balance sheet stress. And as far as long-term growth story is concerned, India is still highly underserved credit market with credit to GDP ratio at around 55 to 60%, which is very low as compared to global peers like US and China. And for India to become $10 to $20 trillion economy, this credit growth via private banks would play a very important role. So there is massive scope for growth. Also with growing urbanization and aspirational young population, there is going to be more and more demand for loans across category, including home loan, vehicle loan, education loan, personal loan, credit card spending and so on. Today, Indian private banks have adopted digital banking that is also helping them in terms of lower cost to income ratio by reducing the operational cost, faster customer acquisition, along with better cross-sell opportunity via data analytics. So well-run private banks with strong brand name would continue to grow. Having said this, competition risk would always exist. And another challenge as discussed is deposit growth. So basically credit growth is not a challenge for banks. There is enough demand. But deposit growth is relatively slower. And banks' business model is such that they borrow money in terms of deposit and lend it as a loan. So if deposit growth reduces, they won't have enough money to lend. The key reason for slow deposit growth is depositors are increasingly diverting saving to higher yield or more liquid alternative such as mutual fund, equity market and small savings scheme. Especially the Indian stock market's strong outperformance in the last few years and the rise of wealth management products have drawn funds away from traditional bank deposits. So this challenge has to be monitored closely. Now let us quickly look at the top private sector banks and their comparative analysis. Okay, before we do the comparative analysis on important KPIs, let us quickly understand the journey of these private lenders in the last few years. So the biggest outperformer without a doubt is ICICI Bank. It has shown a massive turnaround under the leadership of Mr. Sandeep Bakshi. ICICI aggressively focused on digital innovation, shifted towards retail banking and shown a sharp improvement in asset quality. In last 5 years, ICICI Bank net profit has grown from 11,000 crore in FY20 to now at 54,000 crore. And its stock price has grown more than 4 times from levels of 330 to now at 1450. The best performance among private banks. As a result, ICICI Bank that once used to trade at lower price to book multiple now command a premium price to book multiple. Basically, the market has rewarded it due to its superior performance that led to valuation re-rating. Now, HDFC Bank that was once the leader in Indian private banking sector has faced multiple challenges. First of all, HDFC Bank lagged behind ICICI in terms of digital innovation. Its digital banking platform faced multiple outages in the past due to its inability to handle high transaction volumes. Although now the situation has improved significantly. Then another challenge was integration with HDFC Limited. In 2023, HDFC Bank merger with HDFC Limited created significant integration hurdles for HDFC Bank. Also post-merger, HDFC Bank's CD ratio, that is credit to deposit ratio, rose to 110%, forcing it to prioritize deposit growth over aggressive lending. This cautious approach resulted in limited growth compared to ICICI. Having said this, HDFC Bank has consistently maintained its top-notch asset quality. And its net profits have grown consistently from 27,000 crore in 2020 to 73,000 crore in FY25. However, due to all the challenges in the past, HDFC Bank's share price witnessed a long slowdown with negligible movement between January 21 till January 25. And its price to book that used to trade above 3.5 fell down to below levels of 3, even lower than median valuation. Then third, Kotak Bank, which was also one of the top performing private banks, underperformed in the last few years. First problem was with IT system, including a major outage in April 24. As a result, in April 24, RBI banned Kotak from issuing new credit cards and onboarding new clients via digital channels. This ban, similar to HDFC Bank's 2020 credit card restriction, disrupted Kotak's aggressive growth in high margin credit card business. Then second factor was leadership transition and uncertainty. Uday Kotak, the bank's founder and highly regarded banker, stepped down as MD and CEO in September 23 due to RBI's tenure limits. The new management led by Ashok Vaswani has yet to fully gain institutional investor trust. This leadership shift created uncertainty and was another reason behind underperformance in Kotak share price. Then third reason was conservative lending approach. Kotak adopted a cautious lending strategy, particularly during COVID-19 period, prioritizing asset quality over aggressive loan growth. While this preserved stability, it led to slower loan book expansion. Overall, Kotak net profit expanded from 8,500 crore in 2020 to 22,000 crore by FY25. However, its share price did not reflect this growth. It remained muted for 4 years between January 21 till January 25. As a result, its valuations have fallen significantly from price to book of 4 to 5 to now at 2.6, which is way below its median valuation. Then next is Axis Bank. Again, it has been an excellent turnaround for Axis Bank that once struggled badly with asset quality between 2016 till 19. As a result, its net profits tanked badly. However, in 2019, Amitabh Chaudhary took over as MD and CEO of Axis Bank. And since then, Axis Bank has done very well. His focus on disciplined underwriting and risk management resulted in improvement in asset quality and restored investor confidence. Although credit cost in unsecured loans remains a concern. Axis Bank also invested heavily in its digital banking infrastructure, particularly its Axis mobile app and partnership with UPI-enabled platform. Axis Bank processed approximately 1/3 of total UPI transaction in India in 2024. Axis Bank also successfully done the acquisition of Citibank India consumer business, adding 3 million premium customer and strengthening Axis wealth management and credit card segment. However, integration complexities slowed the short-term momentum. Overall, bank's net profit zoomed significantly from 2020 lows to now at 28,000 crore. Its share price also got rewarded with nearly 3 times growth in last 5 years, although it has been consolidating since a long time. In terms of valuation, it trades at price to book of around 2, which is the lowest valuation among its peer. One of the reasons for market giving lower multiple to Axis Bank versus peers is due to probably the lingering perception of pre-2020 asset quality issue with the bank. It seems Axis' strategic effort under Amitabh Chaudhary are yet to fully translate into market confidence. Now let us look at the comparative analysis of all 4 banks across various important KPIs. So this is the comparative analysis of all top 4 banks. If you look at the market cap, obviously HDFC Bank is the largest, followed with ICICI, then Kotak and then Axis. Next important parameter is deposit growth, where we are comparing FY25 deposit versus FY24. And here your Kotak Bank deposit growth has been highest at 16%, followed with 14% for ICICI and HDFC Bank. As we have discussed, deposit growth is going to be very crucial, where Kotak Bank is leading and Axis Bank has got a lower deposit rate. Next important KPI is advances growth for FY25 versus 24, where your ICICI Bank has the highest advances growth 13.3, followed with Kotak at 13, and Axis and HDFC is in lower side. Now in case of HDFC, the bigger reason is because of the merger with HDFC Limited, they had to focus more on deposit growth, and that is the reason their advances are on the lower side. As far as CASA ratio is concerned, again very important parameter, higher this number better it is. Here your Kotak Bank is again a leader with 43% CASA, followed with ICICI Bank at 41.8. Then if you look at the net interest margin, again your Kotak Bank is the highest net interest margin at 4.96%, followed with ICICI Bank at 4.3%. And here your ICICI Bank has got the lowest cost to income at 37.9%. That suggests the best operating efficiency. Then if you look at ROE, ICICI Bank again leads at 17.9%, followed with HDFC Bank at 17.2%. Axis is 16.5, Kotak is lowest at 13.12, but that is because of one-time loss, and we'll discuss it why they've got minus 8% net profit growth. Then if you look at the ROA, return on asset, again your ICICI Bank is number 1 at 2.4%, followed with Kotak Bank at 2.36%. Next is gross NPA and net NPA. Again, all 4 banks have got top-notch asset quality. Again, here within that, if you look at it, Kotak Bank has got the highest asset quality at 0.31% NPA. Next important KPI is the net profit growth in Q4 year on year. Here, if you see, ICICI Bank has got 18%, which is the highest growth. Kotak Bank is minus 8%, and one of the important reasons is because of ban that happened by RBI on their credit card business, and another reason is their provisions got increased in Q4. But please note that the ban by RBI has been lifted on their credit card business, so I expect Kotak Bank to come back sharply. Next important parameter is the net profit growth for entire year FY25 versus 24, where again your ICICI Bank has led with 15.5% growth. The next important parameter is on the valuation. Now obviously if you look at it, ICICI Bank is leading in majority of KPIs, and that is the reason it also commands a premium valuation at price to book of 3.3, which is higher than historical average of 3.1. But if you look at Kotak Bank, it has got price to book of 2.6, which is much lower than its median valuation of 3.7 price to book. And Axis Bank has got the lowest price to book at 2, but then the reason is because among all 4 banks, its performance has been subdued comparatively, and its historical median has also been 2.1. So clearly if you observe, ICICI Bank has been rewarded in terms of valuation re-rating because of its outperformance across KPI. Then next important KPI is retail wholesale ratio, where HDFC Bank is 57:43, ICICI is 52:48, Kotak is 47:53, Axis is higher where 60% is retail and 40% is wholesale. And finally, I have also looked at the analyst target after Q4 result. Again, this is not a very important parameter, but just to get a sense of what brokerage firms thinks about the bank. And please note that this is after Q4 performance. Their target and their valuation re-rating, de-rating happens every quarter. So you have to track that. Based on the latest Q4 numbers and the current market price, here is the potential upside on all 4 banks. HDFC Bank is 10 to 15% upside. ICICI is 13 to 17%. Kotak Bank and Axis Bank has got higher potential upside at 12 to 20% range. And finally, I've also tried to understand what institutional investors are doing with this bank, and all 4 banks have seen increase in institutional holding in FY25 versus 24, where highest is HDFC Bank. So I hope this comparative analysis will give you a better sense in terms of which bank is doing better and where you should take a buy call. So in this video, we discuss the overall landscape for private banking sector of India. While there are certain challenges like NIM pressure in near term and slowdown in deposit growth, there are multiple tailwinds including RBI liquidity push via rate cut and bond purchase, as well as government focus on reviving consumption demand. Structurally, the credit to GDP ratio in India is still very low, and private banks would play a key role in growth of India's GDP from 4 trillion to 10 trillion in next 10 to 15 years. As far as investment opportunity is concerned, ICICI Bank has clearly outperformed the peers in last few years. But as a result, it also commands a premium valuation. I believe ICICI Bank would continue to do well and command a premium valuation among peers. But at the same time, I think if HDFC, Kotak and Axis Bank can do well in FY26, there is scope for valuation re-rating, especially for Kotak and Axis Bank. So this is it for this video. Now tell me in the comments, do you think private banks will outperform in FY26 or not? And which private bank are you holding in your portfolio? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.